Chapter 4, The Interdependencies. The devil is always in the details. The central point that I would like to emphasize as the objective for this chapter is that while it is most important to appreciate the structure of the balance sheet and the profit and loss statements, a firm foundation on how these figures are accumulated is the most essential part of mastering this subject. This chapter focuses on laying this foundation and stresses on how the highest order of presenting the financial records is intertwined unmistakably to the rules of debit and credit. We already established that while the rules of debit and credit are pegged to an account type, real, personal, and nominal, the balance sheet and profit and loss statements are easily understood from an account category point of view: asset, liability, capital, expense and income. By establishing an untenable relationship between an account category and account type, we will seek to understand how each accounting transaction that is recorded in the books of accounts using the rules of debit and credit find their expression in the profit and loss statement and the balance sheet. The following table summarizes this understanding. Capital. Capital is represented by a personal account, as it is owed back to the provider of the funds by the business entity. Liability. All liabilities are personal accounts as they are claims by other entities on the business entity. Asset. A real or personal account can represent an asset. Assets that represent physical resources are real assets. Assets that are claims on other entities, typically those that are represented as liabilities in another entity's books, are personal assets. A strange but interesting exception is that intangible assets like goodwill, expenditure, long-term expenses, reflect collective perspectives about the organization and hence are personal assets. Income and expenses. The income and expense aspects of the transactions conducted by the business entity are recorded in nominal accounts. These accounts are relevant only for a reporting period and will neither have an opening balance or a closing balance. It is evident from the above table and the previous chapter that only real and personal accounts find a place in the balance sheet statement. Nominal accounts find a place only in the profit and loss statement. But if this were to be true, then the balance sheet will have different totals in the assets and liabilities side, and it would be a misnomer to call it a balance sheet. The reality is that no account type escapes an expression in the balance sheet. Page 17 of 64. Although nominal accounts find an expression only in the profit and loss statement, they find a place indirectly in the balance sheet, by way of the profit/loss balancing figure being shown under liabilities or assets respectively. To make it even simpler to understand, the current reporting period's profit/loss component in the balance sheet can very well be replaced by income on the liability side and by expenses on the assets side and be prepared as one consolidated statement. The justification for income and expenses finding a place in the liability and asset side respectively is the same as given earlier for profit/loss balances. If this were the case, then why should a student of this subject be confused with learning two statements? Both have their unique purpose, and I will use this opportunity to drive home the following points. The profit and loss statement is a flow statement that represents the performance of a business entity during a given reporting period. Hence it will consume the balances of all the nominal accounts and reinitialize them to zero balance for the next reporting period. The net effect of their balances is known as the profit or loss of that reporting period only. From an accounting standpoint, this profit or loss balancing figure is transferred to another account by the name P&L reserves. This account holds the accumulated profit or loss balance of the business entity since inception. The balance in this account is the one which is shown under the liability or assets side of the balance sheet. If this account has a historical profit to show, it is viewed as an obligation of the business entity towards its equity capital providers and is treated as a personal account type under liabilities. If this account has a historical loss to show, it is viewed as an obligation of the equity capital providers towards the business entity and is treated as a personal account type under assets. The balance sheet is a position statement as at the end of a given reporting period, as it always shows the cumulative values since inception of the business entity, of not just the real and personal account types, but also of the nominal account types via the P&L reserves account. Page 18 of 64. The following representation of the balance sheet has been put together from an account category and account type perspective so that the rules of debit and credit can be overlaid in the minds of the readers. (19 of 64). Vindicating the dual aspect. Let me conclude this chapter by reinforcing the foundation of accounting laid in Chapter 2, which is the dual aspect. The balance sheet is a statement that balances on both the sides, and hence the following simple equation can be right away conceded. Capital plus liabilities equals assets. As established earlier, the profit and loss elements are mutually exclusive, and their historical values are only liabilities or assets themselves. So the above equation can also be recast as follows. Capital plus liabilities plus accumulated profit equals assets plus accumulated loss. In other words, accumulated profit equals assets minus capital plus liabilities, or accumulated loss equals capital plus liabilities minus assets. The best way to understand this is as follows. If the business has been performing well, then its assets would have grown more than its capital and liabilities to the extent of its accumulated profits. If the business has been performing badly, then its assets have been eroded and it needed more capital and liabilities than it started off with to the extent of accumulated losses. We also saw in the previous section that the profit and loss statement is a flow statement of a reporting period, while the balance sheet is a position statement as at the end of a reporting period. Therefore, if you take a balance sheet as of the beginning of a reporting period, and as at the end of that reporting period, and subtract the aggregate values of the following account categories, then the following equation will also hold good. Reporting period profit equals incremental assets minus incremental capital plus liabilities. Reporting period loss equals incremental capital plus liabilities minus incremental assets. The dual aspect of recording transactions is the only logical explanation for an operating period's profit or loss being the same when computed as either of the following methods: the difference between the income and expense incurred during a reporting period, or the difference between incremental assets and incremental capital plus liabilities between the starting and ending dates of the reporting period. We already saw that the fundamental unit of an accounting system is the journal entry that records all the transactions as an equation of debits and credits. Hence the fundamental unit of each incremental value is a journal entry. Page 20 of 64. When we attempt to understand the impact of a journal entry in the balance sheet, we must always remind us that, but for this entry, the balance sheet is already in a balanced state. The impact of each journal entry can be directly analyzed with respect to its impact on the balance sheet with the help of the following table. Account category asset. Natural balance, debit. Impact of each debit increases balance. Impact of each credit decreases balance. Account category capital or liability. Natural balance, credit. Impact of each debit decreases balance. Impact of each credit increases balance. Account category expense. Natural balance, debit. Impact of each debit increases balance. Impact of each credit decreases balance. Account category income. Natural balance, credit. Impact of each debit decreases balance. Impact of each credit increases balance. The term natural balance is being introduced to convey the expected type of balance for an account category given its link to an account type, and hence in turn its link to the rules of debit and credit. For an asset, since it is a real account type, if you debit what flows in and credit what flows out, it is intuitive to understand that it will logically have an economic value only if it had more debits than credits in its lifetime of existence. For a liability, since it is a personal account type, if you debit the receiver and credit the provider of a benefit, then if the debits to the account are more than credits, then it is a net receiver, and hence obligated to the business entity, and hence an asset. If the credits to the account are more than debits, then it is a net provider, and hence the business entity is obligated to who it represents, and hence a liability. For income and expense, since they are nominal account types, the rules of debit and credit are a straight interpretation. Expenses are always debited and hence will have a debit balance. Incomes are always credited and hence will have a credit balance. Note, these accounts will only have a balance during the reporting period as their balances will be transferred to the P&L account at the end of the period. Let us look at an example where an asset named air conditioner 1 worth $20,000 has been sold for $12,000 at a loss of $8,000 to a scrap dealer, who is yet to pay for the same. We will first look at how its journal entry will look like, but now that we are more familiar we will introduce two columns for account category and account type as well. Account name. Account type. Account category, rule, amount. Scrap dealer. Personal asset. Debit. $12,000. Loss on sale of furniture and fittings. Nominal expense. Debit. $8,000. Air conditioner 1. Real asset. Credit. $20,000. Total $20,000. Page 21 of 64. Let us analyze the above journal entries' direct impact on the balance sheet. For an asset, the natural balance is on the debit side. A debit of $12,000 to scrap dealer will increase the overall assets by $12,000. A credit of $20,000 to air conditioner 1 will decrease the overall assets by $20,000, hence the net impact is that the assets have gone down by $8,000. This is counterbalanced by the debit to the expenses in the form of loss on sale of furniture and fittings, which will either go towards reducing profits by $8,000, bringing down the liabilities side, or go towards increasing losses by $8,000, bringing up the assets side. If we do not look at this transaction as a silo, there can be three scenarios based on overall profit and loss position, as dictated by other transactions of the reporting period. If the overall profit and loss position for the period is a profit equals $8,000, then the profit figure on the liability side will be brought down by $8,000 because of the expense. If the overall profit and loss position for the period is a loss, then the loss on the asset side will be increased by $8,000 because of the expense. If the overall profit and loss position for the period is a profit, say $6,000, then the liability side will go down by $6,000 only, and the loss of $2,000 would be recorded as an asset, ensuring that the net impact on the asset side is also a reduction of only $6,000. It is not practical to trace every transaction right up to its impact on the balance sheet, but the concept holds good for every transaction. I hope this analysis gives you a good insight of the interlinkages among various elements like account type, account category, profit and loss statement, and balance sheet statement. Do not forget that the comprehensive logic of interdependence between each of the rules of debit and credit is what held these interlinkages tightly together. I am pretty sure that by now the subject is a lot friendlier, and you are now almost ready to take the joyous ride with the complete cycle of accounting in the next chapter. If you are still in any self-doubt, I strongly suggest that you read chapter 1 through 4 till you internalize these interdependencies.